Again, good morning, good afternoon, or simply good day, depending on where you're joining us from. Thank you for joining the second webinar in the BAFT Future Leaders 2026 series for the future class of 2026, the 11th class of the program. I'm Daniel Pino, and I oversee the BAFT Future Leader program. This webinar series was created to give project teams the opportunity to take a deeper look at the white papers they presented at the BAFT Global Annual Meeting, and we're pleased by the strong interest in the series has generated so far. A couple reminders. Everyone is muted to reduce any noise or distractions during the presentation. Video is also turned off for everyone except our speakers. The webinar recording will be posted after the session. A couple of screen navigation reminders as well. Please submit your questions using the Q&A button there. And you can also raise your hand, since everybody's muted, under the reaction box if you want to ask a question verbally. And we will unmute you. And today's session focuses on BAFT's position on non-bank in trade and supply chain finance, a topic that has generated significant discussion across the industry. Each year, BAFT councils submit potential topics and the board select those that the future leaders develop into white papers. The team's white paper is available free of charge to BAFT members in the online store under Member Tools and the Future Leaders white paper. Before we begin, I'd also like to note that the applications for the 12th class of the BAFT Future Leaders program will be open in early August. Candidates must be nominated by their BAFT member organization, and the application link will be sent to each organization's primary contact. If you have any questions about the program, please feel free to reach out to me. And with that, I'll transfer over to the team to continue their presentation. So Shelby, you can start sharing your screen.
Good morning, or good afternoon, everyone, and thank you for joining us. It's a pleasure to be here to open today's discussion on BAFT's position on non-bank financial institutions in trade and supply chain finance. So, just as a brief introduction, our panelists here are all part of the BAFT 2026 Future Leaders program, and this is a culmination of what we've been working on over the last 6 months. We represent multiple different banks and institutions, as well as a variety of experience across global transaction banking. This is a 45-minute webinar session where we will take you through our paper, along with 15 minutes of Q&A at the end. Please do post questions throughout the webinar via the chat function. As Daniel mentioned. So, Shelby, you can move to the next slide. At a high level, this paper makes a simple but important point. Trade finance is at an inflection point. Demand remains strong, the asset class continues to demonstrate a resilient risk profile, and global trade still depends heavily on access to working capital and risk mitigation. And yet, the system that supports trade finance is under growing strain. This challenge is well known. We continue to see a significant global trade finance gap, estimated at around $2.5 trillion, with the burden falling disproportionately on SMEs and emerging markets. At the same time, banks are operating at an environment of rising regulation, compliance, and operational complexity, which is making it harder to serve all parts of the market at scale. What is changing, however, is the structure of the market itself. Trade finance is no longer a purely bank-led ecosystem. The non-bank financial institutions, private credit providers, insurers, fintechs, and digital platforms are now playing a much more material role across origination, funding, distribution, and execution. So the real question is no longer whether non-bank capital has a role to play. It clearly does. The real question is how banks and non-banks can work together in a way that is scalable, trusted, and resilient. And this is really the central piece of the paper that we've written here around collaboration and multiple participants. The main constraint on scaling trade finance is not capital alone. It is governance, transparency, and trust. Capital is increasingly available. What the market still needs is a stronger framework for collaboration, one built on clearer standards, stronger due diligence, better data integrity, and greater confidence across the value chain. Why does this matter now? This matters because distribution is no longer optional. Regulatory developments, including Basel III endgame reforms, rising compliance costs, and continued pressure on bank balance sheets means that more collaboration and distributed models are becoming a structural necessity rather than a tactical choice. At the same time, recent market failures have shown that growth without strong governance can quickly undermine confidence. In a more interconnected ecosystem, weaknesses in origination, verification, data quality, or platform resilience do not stay isolated. They can affect multiple participants at once. What this paper sets out to do is move beyond a simple banks versus non-banks debate. Instead, it frames the future of trade finance as an ecosystem of complementary roles. Banks providing underwriting discipline, trust, and compliance client relationships. Non-banks and private capital providing additional flexibility and capacity, while fintechs and platforms enables greater efficiency, connectivity, and scale. The paper also draws on survey findings, the first of its kind, market developments, and practical examples to show that collaboration is already happening, but that it remains difficult to scale consistency without a stronger, common standard and clearer role definition. So the message I would like to leave you with at the onset is this. The future of trade finance will not be defined by fragmented competition, but by coordinated collaboration. If the industry can strengthen the foundations of trust, transparency, and operational resilience, then there's a real opportunity to not only mobilize more capital, but to expand access to reliable and sustainable trade finance where it's needed most. With that, let me hand off the intro to this discussion.
Thank you, Oliver. Good afternoon, everyone. Let's start by framing the current landscape of the trade and supply chain finance sector. In 2024, global trade in goods and services reached roughly $33 trillion, with goods alone representing around $25 trillion. A size that still grows despite a recent slowdown. On the other hand, services have experienced a more stable evolution, around $8 trillion in 2024, but in steady progression over the past 5 years. So while global trade has surged over the past decades, recent geopolitical developments have certainly exposed the vulnerability of supply chains. Fragmentation patterns in global trade have increased since 2020, driven by geopolitical realignment, revised industrial policies, and efforts to diversify supply routes. This evolving environment has intensified the need for risk mitigation and working capital support, which are core features of trade finance. After a volatile post-pandemic period, global trade growth tempered in 2025 amid tariff uncertainties, sanctions, frictions, and cooling developed demand, especially in developed markets. Let's now try to understand what are the root causes of the trade finance gap. And just to clarify, when we refer to the trade finance gap, we are talking about the difference between financing needs requested by corporates and what financial institutions or other market participants are willing or able to provide. A 2025 paper from the Asian Development Bank shows that the global trade finance gap reached $2.5 trillion in 2025, which is equivalent to roughly 10% of global trade of goods, as we previously mentioned. This gap widened sharply from 2020 to 2022, from around $1.7 trillion to around $3.5 trillion, reflecting a 47% increase in just 2 years, but has remained stable ever since. So while drafting our paper, we examined numerous studies on the trade finance sector, and it identified three recurring themes. The first one is that demand for risk mitigations continues to outpace supply, especially in key corridors, such as for SMEs and in emerging markets. The second one is that compliance and sanction screening are key concerns and rising cost drivers for banks. And the third one, but not very important, is that capital efficiency remains paramount, prompting renewed focus from banks on the originate-to-distribute strategy. Regarding the concentration of the trade finance gap, emerging markets account for a disproportionate share of the global trade finance gap. South and Southeast Asia face elevated rejection levels, exceeding 40% for SMEs, and across Africa more broadly, SME rejection rates can reach up to 55%. And this underscores a persistent challenge in these regions. The trade finance gap is also increasingly impacted by regulatory and balance sheet constraints, rather than a lack of the underlying trade demand. As regulatory reforms move from design to implementation, especially across European jurisdictions, banks are translating them into more conservative balance sheet allocation decisions. If we now move to the outlook and emerging trends, momentum for digitalization in trade is certainly building, championed by enhanced connectivity solutions. However, adoption rates and pace are not uniform, mainly driven by local market practices and access to digital infrastructures. Trade finance is currently undergoing a pivotal transition from a paper-intensive, balance sheet constrained service to a digitally enabled, investor-connected, and startup-driven ecosystem. The outcome is clear. Risk performance is strong, demand remains unmet, and technology plus distribution will help to unlock additional capacity. Over the next few years, the leadership in this space will belong to institutions who will be able to be at the front of digital innovation, but also to those who will be able to involve parties such as private capital providers through transparent and well-governed distribution channels. I will now hand over to Falk, who will walk us through the evolving roles of market participants.
Many thanks, Leone. And we can stay on this slide basically. So as already mentioned, trade and supply chain finance has traditionally been delivered through an integrated bank-led model where financial institutions manage the entire life cycle. This included origination, underwriting, funding, risk management, and distribution. In this model, banks functioned as central intermediaries, basically, maintaining control and accountability over the entire value chain. In the past decade, however, this model has experienced a major structural shift. Regulatory reforms, technological progress, and changes in capital markets have led to the gradual unbundling of traditional banking functions, resulting in a more distributed and specialized ecosystem. As a result, trade finance today is best understood not as a single product delivered by one single institution, but as a shared operating system in which banks, non-bank financial institutions, fintechs, and others all play interconnected roles. Banks themselves remain the anchor of this ecosystem and continue to provide the market with its core foundation of trust. The strengths of banks are more or less undeniable because through long-standing client relationships, they got deep understanding of their client base, the underlying trade business, and obligations and country exposure. Their access to retail deposits, backed by more or less implicit government guarantees, provide banks with low costs of funds, especially as compared to NBFIs, which must typically fund themselves through equity, institutional debt, or asset management vehicles. And coming along with this, banks also play a central role in credit underwriting, structuring, risk governance, based on their established rating models and risk frameworks, which also benefits other market participants in complex deals. Lastly, they also serve as more or less governance and compliance anchors because their responsibilities under AML, KYC sanctions, and trade-based fin crime programs help ensure that transactions meet legal standards. At the same time, though, banks are operating under increasing regulatory pressure. Post-crisis regulatory reforms, resulting in Basel III, among others, also had far-reaching and sustainable consequences for banks' trade finance capacities, also from a capital perspective. In fact, the framework's core mechanism, the requirement that banks hold more or higher quality capital against risk-weighted assets, also for trade finance instruments, directly affects trade finance economics. But it basically does not stop there. Heightened KYC and compliance requirements are becoming increasingly costly for banks. So just as an illustration, US and Canadian institutions alone faced fin crime compliance costs of $61 billion in 24, which is approximately 60% up as compared to pre-crisis levels. And all this in times when regulators are imposing increasing penalties for AML and sanction failures. So considering this environment, the risk reward for selected sectors and jurisdictions is becoming less favorable, leading to many banks ultimately withdrawing from this business. De-risking, as such, has been most severe for selected sectors, SMEs, as well as for smaller countries and high-risk jurisdictions. And this is exactly where non-bank financial institutions have become increasingly important. NBFIs now provide much of the additional flexibility and liquidity that the market needs, especially in areas where banks are constrained. Historically, many of them participated only as downstream investors, purchasing assets originated and structured by banks. This model helped banks improve capital while giving institutional investors access to short-term self-liquidating assets. In this setup, banks were mainly responsible for origination, underwriting, and servicing, while NBFIs played a mostly passive role. In recent years, though, NBFIs have increasingly expanded their role. Private credit funds, factoring companies, insurance-backed structures, and others are now involved not only in funding, but also in some cases in origination, structuring, and direct client engagement. Their advantage is specialization and flexibility. They can often move faster than banks, tailor structures more pragmatically, and support transactions or counterparties that fall outside traditional bank appetite, including, for instance, SMEs and emerging market clients. In that sense, NBFIs are not simply replacing banks, but they're extending the market's reach. Their competitive advantage on the risk capital side and lower regulation, though, creates new demands for governance as more funding and risk move outside the regulated banking framework. And this also comes along with questions around underwriting quality, transparency, and servicing standards, as it will be elaborated on at a later stage of our presentation. Lastly, running alongside banks and NBFIs are fintechs and trade platforms, which increasingly provide the digital infrastructure that makes this more distributed model workable. Their role is less about supplying capital and more about enabling execution. As we know, trade finance has historically been slowed by paper documents, fragmented workflows, and manual checks. So fintechs help address these inefficiencies by digitizing documentation, automating workflows, and improving onboarding, as well as creating better connectivity among market participants. This is of special significance for SMEs, which have often been more or less excluded from trade finance because onboarding costs were too high and reliable data was too scarce. By improving data capture, standardization, and visibility, platforms can help lower those barriers. Consequently, fintechs are rather enablers, not substitutes for financial intermediation. They do not replace credit judgment, legal accountability, or compliance. In fact, their growing participation introduces a different category of risk, including cyber dependency, questions over data ownership, and operational resilience on shared platforms, which we'll also still elaborate on. So based on that, and as you can already see, based on this vast set of market participants, part of our project was also to find out how those market participants perceive those forms of collaboration, as explained by Leone in the following section. Handing over to you.
Thank you, Fogg. Building on the macro context, our group undertook additional market research through a targeted survey. The survey was distributed to a wide variety of market participants, such as banks, non-bank funders, trade credit insurers, and fintech and platform providers. We intentionally targeted participants with global as well as regional activity across all continents to ensure a balanced representation in our survey. As you can see, the respondent base is swayed towards banking institutions, followed by fintech and capital providers. The 45 survey respondents reported activity across every major trade corridor, with Europe leading the group, followed by North America, APAC, Africa, Middle East, and Latin America. This geographic diversity resulted in very interesting views on risk appetite, regulatory concerns, and the urgency or not of bank and non-bank collaboration between especially emerging and developed markets. What is clear is that the industry is no longer debating whether non-bank capital has a role in trade and supply chain finance. That role is already established and expanding. The more urgent question is whether this increasingly interconnected ecosystem can scale responsibly without weakening governance, transparency, and overall market resilience. So the survey questions we prepared were designed to test a series of underlying assumptions here on the right-hand side of the slide on how, if you can switch it away, yeah, perfect, on how trade and supply chain finance sector is currently evolving as non-bank participation expands. So the four hypotheses that we want to test are the role of non-banks in supply chain finance. The differentiated strengths are recognized by the role is integrated. Scale is not constrained by governance, not by capital. And trade and supply chain finance ecosystems require active coordination between banks and non-banks. So if we move to the next slide, the survey results showed a structural shift in market dynamics, with non-bank institutions moving away from peripheral roles. Although banks remain central to the ecosystem, the growing presence of fintech platforms, private capital providers, signals a diversification of funding sources and operating model. A consistent theme across survey responses is that non-bank participants are not viewed as direct replacements for banks, but as being able to address structural gaps that banks are less able to serve efficiently or sustainably. Non-banks are most often associated with higher risk appetites, balance sheet flexibility, and speed of execution, enabling them to support segments such as SMEs or emerging market corridors. Looking ahead, respondents anticipate continued growth in private capital participation, alongside increasing the standardization of partnerships model. The most sustainable models are widely seen as those that combine bank-led origination and client management with non-bank distribution and technology-enabled platform connectivity. I will now hand over to Abu, who will walk us through the key risks of this interconnected ecosystem.
Thank you very much, Leone. And thank you again, everyone, for joining. As we explore the growing role of non-banks in trade finance, one observation became increasingly clear. The challenge is no longer simply mobilizing capital. The challenge is ensuring that a more interconnected ecosystem remains trustworthy, transparent, and resilient. As trade finance evolves from a bank-led model into a network involving banks, fintechs, non-bank lenders, investors, insurers, and development institutions, risk is no longer concentrated within a single institution. Instead, risk becomes distributed across multiple participants. This creates four key areas of concern. The first one is data integrity and fraud risk. As we know, trade finance increasingly relies on digital data, automated workflows, and platform-generated information. As more participants rely on data they did not originate themselves, the quality and reliability of that data become critical. The industry has seen examples where weaknesses in asset verification or receivables validation have undermined confidence in financing structures. When confidence in underlying asset deteriorates, liquidity can disappear very quickly. The second one is governance and standard fragmentation. Different participants often operate under different regulatory frameworks, risk appetite, and operational standards. While diversity brings innovation, it creates inconsistencies in due diligence, reporting, and accountability. These functions become distributed across multiple entities, and the clear ownership of responsibilities become important. Third, we have liquidity and systemic transmission risk. The ecosystem is becoming more interconnected. Banks, private capital providers, insurers, and platforms are increasingly linked through common transaction and funding structures. It also means that stress affecting one participant can be transmitted more rapidly across the ecosystem. And finally, we have the platform dependency and operational resilience. Technology platforms have become central to modern trade finance operation. They create significant efficiencies, but they can also become critical points of dependency. Cybersecurity incidents, operational disruptions, or failures at key platforms could have consequences extending beyond a single institution. The common thread across all of these risks is that they are not purely financial risk. They are fundamentally a risk of trust. Next slide, please. So the good news for us is that these risks are manageable. Our research suggests that the objective should not be to slow innovation or restrict participation. Instead, the focus should be on building confidence as the ecosystem grows. The first priority is strengthening verification and auditability. All participants need confidence that underlying trade assets are genuine, properly documented, and independently verifiable. The second is improving transparency and accountability. As multiple participants collaborate across the value chain, the responsibilities must remain clearly defined and visible. The third is enhancing liquidity and operational resilience. This means understanding funding structure, reducing concentration risk, and ensuring consistency planning for critical infrastructure. And finally, the ecosystem must continue to strengthen controls around technology, data, governance, and AI-enabled processes. The goal is not simply to manage risk. The goal is to create confidence across the market, because confidence will lower fraud risk, and confidence will improve coordination. That same confidence will then attract capital and ultimately enable the ecosystem to scale in a sustainable way. That is why we've been straightforward in our approach in this research. For we believe that the future of trade finance will not be determined by how much capital enters the market, but whether participants can maintain trust, transparency, and accountability as the ecosystem become more interconnected. That being said, I'll let you guys in good hand with Cassia to discuss about what good look like. Thank you.
Thank you, Abel. And as you can see, BAFT can mean something more than just the association, but we'll come to that in a moment. So talking about the future, imagine this. A few years from now on, a textile supplier in Sri Lanka requests an early payment for an invoice raised to their European buyer. At the same time, a coffee supplier in Kenya receives an order from their American buyer. Nothing unusual, you might think, except for what happens next. Within minutes, not weeks, they access working capital. No endless paperwork, no back and forth emails, no uncertainty about approval. The transaction is already verified, digitized, and shared across the trusted network. A bank and a non-bank lender co-originate and co-underwrite it, drawing on the bank's relationship with the buyer and the non-bank's expertise of the SME market. Credit insurance provides coverage, dynamically adjusting limits based on real-time transaction and performance data. Private investors provide additional funding capacity instantly. And to top it off, a fintech platform connects it all seamlessly. From the supplier perspective, feels simple, effortless even. But behind the scenes, there is something powerful happening. A trusted, compliant, efficient, and highly coordinated ecosystem built on shared standards, aligned roles, clear risk ownership, and most importantly, trust. Every participant in that transaction knows where the risk sits, who owns it, and how it's being managed. One version of the truth based on standardized, transparent, high-quality, real-time data. In that world, trade finance isn't a bottleneck anymore. It's embedded, it's reliable, it's scalable. And capital flows to where trade actually happens. So when an asset is created in Sri Lanka, or Kenya for that matter, it could be understood, trusted, and funded anywhere. And that's how we start narrowing the trade finance gap, by extending finance to the traders who need it most. But, and this is a critical point, this transformation won't happen by itself. And we all here on this call and outside of it have a critical role to play, because it requires coordination, it requires alignment, and it also requires the industry to move and work together. And this is exactly where BAFT can play a critical role as a neutral industry body that can connect participants, align practices, and build trust at scale. Now the question is, how can BAFT help turn this vision into reality so that we move to this future even faster than we could imagine? So if we can move to the next slide, we've prepared a few recommendations. First of all, BAFT can support the development of baseline market standards. Today, we oftentimes fund the same risks, but with different rules. That fragmentation reduces transparency and weakens trust. BAFT is uniquely positioned to bring the industry together to define common standards and expectations around asset verification, duplicate financing controls, reporting, and auditability. The goal here is consistency, not uniformity, to make collaboration scalable and trusted. Second recommendation, BAFT can also promote common due diligence practices. The key barrier to scale isn't capital, as it was already said. It's confidence in how transactions are originated and monitored. Through its convening power, BAFT can help align on principles such as obligor verification, eligibility criteria, ongoing monitoring, audit and review standards. And this reduces friction across participants and strengthens mutual trust, which is critical to scaling partnerships. Next one, operational resilience. BAFT can also strengthen operational resilience across this very dynamic ecosystem. As platforms and shared infrastructure become central, failures can no longer be isolated. They affect the entire market. BAFT, in this instance, can help define guidance on contingency planning, fallback servicing models, and third-party risk management to ensure that collaboration remains stable, even under stress. To answer one of the questions that popped up in the chat regarding the regulatory dialogue. This is our next recommendation. BAFT can also deepen dialogue with policymakers, regulators, and supervisors. As we know, trade finance operates globally, but regulation is local and quite fragmented, which is why BAFT can definitely act as a bridge between the industry and regulators to promote greater alignment on how similar risks are treated. It's not about reducing oversight, it's about avoiding inconsistencies and bringing all the parties to the table so that they are heard and the dialogue and awareness can start. The last recommendation, you might think, oh, how are we going to bring all this theory, bring all of these recommendations from theory to practice? BAFT can really play a critical role, and we've already seen it at all the conferences organized by BAFT, bringing people together, but also creating targeted pilots and cross-industry working groups. For instance, to work on real use cases, such as bank-led receivables programs with non-bank funding, risk-sharing structures, and multi-platform funding models. There could also be, for instance, pilots to explore areas like due diligence, verification, governance. The goal here is simple: to test the waters, to see what works, refine emerging practices, and build market confidence through proven models, not just concepts or white papers. Which brings me to my last slide, the conclusion. The conclusion here is clear. Collaboration is no longer optional. It's the foundation of the future of the trade finance ecosystem. And in this environment, trust really becomes the most important currency. If standards are unclear or inconsistent, liquidity really disappears exactly where it's needed most. And this is not about just banks competing with non-banks. It's really about combining strengths. Banks providing discipline and trust, non-banks excelling at flexibility and liquidity, and fintechs providing connectivity and efficiency. And ultimately, it's also not about efficiency or returns. It's really about the impact. Coming back to our opening statement, where we mentioned the trade finance gap, it's really that type of impact, closing the 2.5 trillion US dollar gap and extending finance to the smallest, most vulnerable traders who need it most. And that's the real measure of success. And that's why this transformation really matters. Also, just to finish off, I'd like to take this opportunity to thank our sponsors, our mentor, our employers, and BAFT, of course, and also all of the incredible individuals on this call and not, who participated in our survey and shared their valuable insights. Thank you very much. It's been an absolute pleasure to work on this revolutionary, one-of-a-kind project. So thank you again. And now it's time for some questions.
Thanks, Katja. All right. Well, I will begin moderating the Q&A session here. I believe Shelby Lee and Joel Paulson will field the questions that we received in the chat, but I open up the floor to all of our participants here if there are any additional questions. So the first question that came in is, what can regulators and supervisors actually do to help banks and non-banks to cooperate more actively to facilitate trade finance?
Should I jump in, maybe, Shelby? In general, probably from my point of view, right, it would be to level the playing field. I think both kind of on the regulating side, not too heavy, and kind of hence creating some sort of joint upside on the collaboration. I would say today there is too many kind of hurdles and too complex in terms of compliance, capital requirement that differs between if it's a bank, a non-bank, and so on, and also kind of if we look at the risk transfer side, where we get a risk transfer or where you don't get it. So I would say just try to get it more even and a level playing field in general on all of these questions.
Thanks, Joel. Another question we received was, another group player that has filled in the trade finance gap is the commodity companies, including assuming some risk. How do you define their role, and do they compete with banks or complement?
Do you want to take that, Shelby, or should I? Yeah.
You go ahead and follow.
Yeah, sure. No, but I think in general, right? I would say both. I think it's quite complementary when it comes to these commodity firms. I would say they have a lot of expertise, and they do have the capability to do to some extent more structured stuff than some of the banks, at least the smaller banks. So I do see the upside with them, but of course it's competition as well. So I would say it's complementary, but please fill in, Shelby, on your end.
Yeah, and based on our research and the insights we've learned from this survey is that it's everyone or the market participant wants to scale their businesses. It's about the scaling with the specialization. So banks have specialization in the origination, client relationship, and the underwriting, and they're also cheaper financing from deposits, whereas there will be other NBFIs or the private capitals with the different type of funding sources. And then the knowledge with the commodity traders and commodity companies directly. So it's more about the complementary relationship among the participants, and then help each other, and then build the common language and practice and framework to build a common understanding, and also the even playing field for all the participants can support the corporate clients, and especially when it comes to narrowing the trade gap that we mentioned about the $2.5 trillion currently existing in the market. So that's our view thus far.
Well, sticking with you for a second here, Shelby. Recent fraud cases seem to have impacted more banks, including entire SCF teams paying the price, more so even than NBFIs. Why and how are we able to address this unbalance?
I think we've learned a lot of lessons from Princeton some years ago, and the first brand last year, and the Tricolor this year. So it's a mix of the banks and the non-banks who have been funded and facilitate the transactions. And also in the first brand's cases, Brayston was a key player in that role. So I don't think it was only the bank or the non-bank who has contributed to that weaken the audit insufficient framework and the structure. So I think this is the where that we can highlight and address that, address the importance of the audit, the compliance and governance. So whether the receivable is validated and existent, how the economics of the participants can be shared. So I don't think it's a one participant who played a key role in that. I think it's everyone can take some lessons from it and then move forward with the control. So previous slide covered by Abu, then key controls is that we need to have this standardized common practice in terms of audit, in that there is a pre-closing audit and the post-closing audit on which is ongoing basis. That who's in charge of it and who's monitoring it. I think those controls are key here.
Thanks, Shelby. Joel, ECAs play an important role. Were there any insights in our paper whether ECA's participation will increase given the current market trend of national competition because of geopolitical issues and the rise of cost of goods?
Yeah, I would say so. In general, if you look at the ECAs, I do think that they will play a larger role going forward. And I think the main part of this is that if you look at the ECAs, at least in the Nordics and then partially in Europe as well, they are to some extent maybe taking too low risk. Looking at their annual reports, they're very strong, quite low credit risk still. So I do think that they will play an even larger role than they have to going forward. And that can also kind of boost, countries' exports and sales going forward. So I do think that. And I also, maybe to add to that question, I do think that ECAs should kind of share best practices more often between each other, because I do think, that some of them have found some very interesting stuff. But, again, it's still, no one has found kind of the key to everything. So, yeah.
Thanks, Joel. What will be the impact of global sustainability and ESG differentiation across the EU, US, and APAC on the compliance aspects of transactions?
Sustainability is tricky. I don't know, Shelby, if you want to take this, but I can lead off maybe and say, like, looking back a few years ago, I do think that kind of banks were really pushing sustainability and kind of the framework and so on. But I do feel that has shifted to some extent, right? That is now rather kind of the global companies driving the framework and pushing kind of their agenda rather than the banks. But it's a very relevant question, and it's tough to kind of, again, see where this will land. And I would say, I think, at least from a Nord perspective, we see less requests for sustainability programs nowadays. Maybe you would add to that, Shelby.
Yeah. So this is something that we have previously discussed among our group, that the current view in North America is quite different than the ones in Europe. The sustainability and ESG is such a strong key words in that market, whereas in North America, a lot of companies have dropped the measure and their tracker of those ESG metrics. So, however, that when we look at the S&P 500 companies and financial reportings, and a lot of clients, especially those major ones, are still reporting and following up on their goals and plans and their progresses. It's good to know, also good to be aware of those the progresses in the market. And it's certainly at one point that needs to be achieved for the current generations and next generations. So I think this is still the key important point that everyone should be aware and follow up.
Hey, Shelby, I know we're running a little tight on time, so we'll try to catch as many of these questions as we can. What is the benefit of NBFIs financing trade rather than financing investments? Abel, would you like to take this one?
Yeah, please. I want to take this. I think actually that's a very good question. I think, as discussed within our group, the main attraction of trade finance for NBFI is indefinitely its risk return profile. Trade finance assets are typically short-term, self-liquidating, and linked to real commercial transaction. So that means that investor can quickly recycle capital and benefit also from historically low default rates compared to many other asset classes. So in addition, I think trade finance provide the diversification, and also returns are driven by trade flows and working capital needs rather than traditional market performance. And many NBFIs see a structural opportunity. Demand for trade finance significantly exceed the capacity that banks can provide due to regulatory and balance sheet constraints. And also for many non-bank investors, trade finance offers an attractive combination of yield, diversification, and exposure to the real economy, also helping close the global trade finance gap. Actually, this is also a trend that we see in Africa today. We have a high demand for trade finance product that can definitely not be covered by the big banks on the continent. Thank you.
Thanks, Abu. I think we have time for one more question. So, what are our next steps? What are the roles that BAFT and the ICC can play with us here? And what should we look forward to next?
I'll kick off on that question, then let others follow up. So International Chamber of Commerce, this is the international body similar to BAFT. So in my opinion, BAFT as an international organization with the hundreds of members, it can play a key role convening all the market participants, and the ICC can complement the BAFT role by setting the standards and the common framework so that common language is spoken among the practitioners of the trade finance and supply chain finance. So especially emerging markets, and now in the Europe and the North America, the market has been fairly well established. And then the BAFT, the RPA forms, there are a lot of common, the templates being used by a lot of banks and then they advise. Whereas the emerging market, they may have a different customs and then practitioners. But if the common standard and the framework are being shared and aligned among emerging and developed markets, they will help further to narrow the trade finance gap.
And if I can jump here as well, I think it all starts with awareness and dialogue, right? So hopefully you've had a chance to read the paper or will have a chance to read our paper. We would like to at some point rerun the survey to include more market participants, especially from the NBFI space. And if there are any questions that you would like to ask us about the survey or the research, please schedule a follow-up call with all of us, or some of us would be happy to talk to you. But again, as I said, it all starts with all of us being a little bit more aware and starting the dialogue and understanding the other side of the equation as well. You can see that there are some also open text answers in the survey, quite interesting, that we also used as quotes. A lot of good insights, and I have to say this is the very first time we've managed to such a survey, such a research has been done. So it's one of a kind, and hopefully one of the first ones that will lay the foundation for the next follow-up studies and hopefully more and more collaboration for the industry.
Thanks, maybe guys. To kind of end off on Kaja's note there, a final thing. So if you do kind of want to move from insight to action, right, based on what we discussed and presented here, right, feel free to reach out to us and try to find some way to collaborate between each other, banks, non-banks, or whoever you represent out there. So yeah, thanks.
Yeah, thanks, Joel. Thank you all for joining us today with this presentation. For any unanswered questions, please reach out individually. We are happy to answer them. The link to the white paper is in the chat. And thank you all again.
Thank you very much.
Thank you.
Thank you.
Invite you to download and read it and please.
And you can also share this webinar as it's also being recorded as we speak. So this presentation will not go unnoticed.
Okay, Daniel, over to you.
Okay, thank you. Hope to see everybody tomorrow. We have another webinar. We'll continue the series tomorrow and next Tuesday and Wednesday. Please register and download the papers. And they very good work done by the future leaders. Thank you, everyone, for attending.